At 9:02 a.m., your money is there. At 9:07, it still is. Same number, same digits. You tap send. Nothing happens. Not an error, not a failure, just a message. Processing. That word should make you uncomfortable because in modern finance, money doesn't need to disappear to stop working. It just needs to stop moving. And when it does, no one announces it. We've been trained to look for drama, crashes, bank runs, red numbers across a screen. But the real system doesn't fail like that anymore. It hesitates first, quietly, systematically, almost politely. And that's what makes this moment important. Because today, money is no longer a physical thing you hold. It's a sequence of approvals, a chain of movements between institutions, banks, payment networks, clearing systems. If that chain slows down, even slightly, the entire system starts behaving differently. Not broken, just restricted. Here's how it actually works. You think you have money in your account. What you really have is a claim, a promise that your bank will deliver that money when you ask for it. Most of the time, that promise holds, because not everyone asks at once. Banks rely on this. It's not a flaw. It's the design. They keep a fraction of deposits as liquid reserves. The rest is moving, being lent, invested, or used elsewhere in the system. So when you make a payment, your bank doesn't just hand over cash, it updates your balance. Another bank updates someone else's balance. Then, behind the scenes, those banks settle the difference. That settlement is where things slow down, because settlement requires liquidity. Real, usable money. Right now. And here's the part most people never see. Banks are constantly lending to each other. Short term, overnight, sometimes just for hours. It keeps the system fluid, but it also means the system depends on trust, not public trust. Institutional trust. If Bank A believes Bank B is stable, money moves freely. If that belief weakens, even slightly, behavior changes. Limits tighten, approvals take longer, buffers increase, no announcement, no panic. Just a subtle shift. Let's be a bit more careful today. Now imagine that thought spreading, not as fear, as caution. One bank pulls back a little, another notices and does the same. A third delays a large transfer. Individually, these are small decisions. Together, they change the speed of the entire system. And speed is everything. Because modern finance isn't built on money sitting still. It's built on money arriving on time. Payrolls, supply chains, market trades, all of it assumes continuous flow. When that flow slows even slightly, pressure builds. Not visible pressure, timing pressure. Think of it like traffic. No one schedules a traffic jam. It emerges. A driver taps the brakes. Someone merges too slowly. A gap closes. And suddenly, miles of cars are standing still. With no clear reason why. Financial systems behave the same way. Except the cars are billions of dollars. And the delay isn't measured in minutes. It's measured in access. Now, here's the uncomfortable math. Banks don't have enough liquid cash to meet all demands at once. They're not supposed to. If even a small percentage of deposits need to move at the same time, the system relies on borrowing, rolling, and continuous settlement. It's a chain. Break the timing, and the chain strains. Stretch it long enough, and parts of the system stop responding normally. Not failing, just slowing. This is where public perception drifts away from reality. From the outside, everything looks fine. Your account balance hasn't changed, ATMs still work. Markets might even go up, but inside the system, decisions are being made in real time. Which payments clear first? Which transfers get delayed? Which institutions get priority access to liquidity? And those decisions are invisible. There's no dashboard for it. No headline that says, liquidity is tightening in Tier 2 settlement channels. It just shows up as friction. A wire that takes longer than expected, a transfer that misses its window, a system that asks you to try again later. Here's the irony. The system is designed to absorb shocks. Central banks exist for this reason. Emergency lending facilities, liquidity injections, But those tools don't activate at the first sign of slowdown. They activate when stress becomes undeniable. And by that point, the system has already been slowing for a while. Quietly reallocating access. There's another layer to this. Creating money is not the same as moving money. You can increase supply, lower interest rates, inject reserves into banks, but that doesn't force institutions to pass it on. If risk feels elevated, they hold it. Liquidity becomes something to preserve, not distribute. So you end up with a strange situation. There's more money in the system than before, and yet it feels harder to access. Zoom out and the implications get wider. When money slows, behavior changes. Businesses delay decisions, investors become selective, credit tightens at the edges. Not because of a visible crisis, because of a subtle change in timing and trust. And those changes compound. Slow movement leads to cautious behavior. Cautious behavior slows movement further. A loop, quiet, self-reinforcing. And still no one announces it, because technically nothing is broken. Systems are operational. Balances exist. Transactions are still possible, just not as freely, not as quickly, not for everyone. So when people ask when financial instability begins, they usually expect a date, a moment, an event. But instability often starts earlier than that, in the gap between available and accessible, in the moment when money is still there, but doesn't move the way it used to. And that leaves a question most people never think to ask. If your money depends on a system that can quietly slow down without warning, at what point does having money stop being the same as being able to use it?